Welcome, everyone, and thank you for joining today's in-depth discussion on one of the most important questions for dividend-focused investors, HDV versus SCHD. Which is the better dividend ETF? Whether you're new to dividend investing or a seasoned investor searching for consistent and reliable income, this video will guide you step by step through a detailed comparison of these two popular funds. So make sure to stay tuned to the very end, and if you enjoy informative investing content like this, please take a quick moment to like this video and subscribe to the channel for more updates and analysis. Let's start with a brief overview. HDV, or the iShares Core High Dividend ETF, was launched in 2011 and focuses on high-quality U.S. companies with strong dividend histories. SCHD, the Schwab U.S. Dividend Equity ETF, was launched the same year and is known for its blend of yield, quality, and growth potential. Although both ETFs might seem similar at first glance, there are major differences in their methodologies, sector exposures, and long-term performance. In today's Part 1, we'll begin by defining what dividend ETFs are, why they're important, and what investors should reasonably expect from them. Then, we'll break down the core objectives of both HDV and SCHD so that you have the right foundation before diving deeper into the side-by-side comparison in Parts 2 and 3. So, let's begin with a basic but essential question. What is a dividend ETF? Dividend ETFs are exchange-traded funds that invest in a basket of publicly traded companies known for regularly paying dividends. These funds give investors exposure to a diversified group of dividend-paying companies, without the need to select individual stocks. In other words, instead of buying and managing 30 or 40 stocks on your own, you buy one ETF and instantly gain ownership in all those companies, with built-in dividend income. Dividend ETFs can be a vital component of a long-term portfolio for three reasons. First, they provide relatively steady cash flow through quarterly or even monthly dividend payments. Second, they tend to be less volatile than growth-only funds, especially during market downturns. Third, dividend-paying companies often have strong financials and disciplined management, which contribute to performance consistency over time. Now that we've covered the basics, let's focus on HDV's strategy. HDV selects high dividend-yielding U.S. companies from the Morningstar Dividend Yield Focus Index. However, it applies a quality screen intended to filter out companies with weak balance sheets or declining fundamentals. The end result is a portfolio of approximately 75 companies, with a strong emphasis on sectors such as energy, healthcare, and consumer staples. This explains why HDV often performs well during market uncertainty, since many of its holdings are considered defensive. SCHD, on the other hand, follows the Dow Jones U.S. Dividend 100 Index. It uses a multi-factor approach that considers not just dividend yield, but also dividend growth rates, return on equity, and cash flow to debt ratios. As a result, SCHD tends to favor companies with a history of increasing their dividends year after year, even if the current yield is slightly lower. SCHD holds around 100 names and has a more balanced sector allocation, including industrials, information technology, and financials, in addition to traditional defensive sectors. Now, before we move any further, if this breakdown is helpful so far, please hit the like button. It really helps the channel reach more viewers who are interested in smart dividend investing strategies. Up next in Part 2, we'll dive into a detailed side-by-side comparison of HDV and SCHD across several key categories: expense ratios, sector weightings, top 10 holdings, historical performance, and dividend yield. We'll look at how each ETF performed in bull markets as well as bear markets, and what that means for long-term investors. In the previous section, we went over the core objectives and methodologies of each fund. Now it's time to dive deeper into their key metrics so you can clearly see how these ETFs differ in practice. Let's begin with one of the simplest, but most important, factors in any ETF: the expense ratio. HDV has an expense ratio of 0.08%, while SCHD charges a slightly lower fee of 0.06%. Although the difference seems extremely small, over very long time horizons, especially for large portfolios, even a few basis points can add up. So in terms of cost efficiency, SCHD has a slight advantage. Next, let's look at sector weightings. This is where the two ETFs begin to show very different personalities. HDV has a heavy concentration in energy, healthcare, and consumer staples. In fact, these three sectors often make up more than 60% of the portfolio. This concentration has pros and cons. On the one hand, many of these companies are large, established businesses with stable earnings and attractive yields. On the other hand, it makes HDV more sensitive to changes in oil prices or healthcare regulation. For investors who want a more defensive allocation, this composition can be attractive. By contrast, SCHD is more balanced. Its top sector weights typically include industrials, financials, information technology, and consumer staples. This diversification tends to make SCHD more correlated with the broader U.S. equity market. The takeaway here is important. If you prefer sector balance and broad market alignment, SCHD might better suit your portfolio. If you prefer a more focused tilt towards stable, high-yield sectors, HDV could be more appealing. Moving on to the top 10 holdings. Let's look at a few representative names to help illustrate the style of each ETF. HDV's top names typically include ExxonMobil, Johnson & Amp, Johnson, Chevron, ABB, and Verizon. These are all well-known, mature companies with consistent cash flows and high dividend payouts. Meanwhile, SCHD's top holdings often include Broadcom, Texas Instruments, PepsiCo, Coca-Cola, and Lockheed Martin. These companies not only pay strong dividends but also exhibit a strong history of dividend growth, which is a core screen used by SCHD's index methodology. Now let's talk about historical performance. Past performance isn't a guarantee of future results, but it still offers valuable insight into how a fund responds under different market conditions. Over the past 10 years, SCHD has generally outperformed HDV on a total return basis. This is largely due to SCHD's exposure to companies that not only pay dividends but also grow them over time, allowing for better price appreciation. HDV, while still delivering solid dividend income, tends to lag slightly in bull markets because its holdings are heavily concentrated in stable but slower growing sectors. On the flip side, during periods of high volatility or broad market decline, HDV often provides better downside protection, thanks to its defensive sector focus. In other words, SCHD tends to win in strong markets, while HDV can act as more of a cushion during market stress. Let's pause here for a moment. If you're finding this comparison useful, please make sure to like the video and share it with a friend who might also be deciding between these two dividend ETFs. Your support helps this channel deliver more detailed investing content like this. In the final section, we'll evaluate the dividend yield and payout growth, discuss income stability, and then wrap up with a clear conclusion on which ETF may be better for different types of investors. We'll also provide a recommendation on how you might even use both ETFs together in a smart, income-balanced strategy. Let's start with headline dividend yield. At the time of this recording, HDV generally offers a slightly higher dividend yield than SCHD, often in the range of 4 to 4.2%, compared to SCHD's 3.4 to 3.7%. That higher yield is largely due to HDV's heavier weight in high-yield sectors like energy and telecommunications. However, and this is important, SCHD has demonstrated stronger dividend growth over time. In other words, even though its yield starts out slightly lower, SCHD's payouts tend to rise faster year after year. This gradual compounding of higher payouts can make a major difference over a 5, 10, or 15-year period. So in summary, if your priority is maximum yield today, HDV will likely pay you more in the near term. If your goal is long-term income growth, SCHD has the edge. Next, let's consider income stability. HDV's income tends to fluctuate more from quarter to quarter, depending on movements in the energy and telecom sectors. SCHD's payouts, meanwhile, are more consistent and predictable, thanks to its quality growth screens. For many long-term investors, especially retirees, consistency matters just as much as yield. A gradually rising and predictable income stream makes it easier to plan cash flow and manage withdrawal rates in retirement. Now let's put everything together and draw a conclusion. Based on cost efficiency, historical total return performance, sector diversification, dividend growth, and income consistency, SCHD is the better overall dividend ETF for most long-term investors. While HDV certainly offers a higher immediate yield and stronger downside protection in bear markets, the total package of SCHD, combining quality, growth, diversification and reliable income, makes it the more well-rounded choice for long-term dividend investors. That said, there's absolutely nothing wrong with holding both. In fact, some investors prefer to split their allocation, using HDV for near-term income and downside defensiveness, and SCHD for long-term growth and compounding income. If you take that approach, you get the best of both strategies. Before we wrap up, if you're finding this video informative, please give it a thumbs up and subscribe to the channel so you never miss future breakdowns like this. Also, leave a comment below. Which ETF do you prefer, HDV or SCHD, and why? I'd love to hear your thoughts. Thank you so much for watching. As always, stay disciplined, stay patient, and stay invested. I'll see you in the next video.